Paulson made, we know, bets that did not pay off for him, macro bets, but it now seems like his position on gold is even going in the wrong direction for him.
That's right. Gold's been a losing bet for Paulson since last year. He told investors last year that it would be his best performing strategy, that his gold fund would be the best performing of all of his funds over 5 years, but that really hasn't played out. Last year, the fund was down 25%, which compares with gold, the metal itself, being up 7%. And this year, the fund is also down 25% in just the first two months of the year. And that's really because gold stocks are the biggest portion of the gold fund and his advantage funds. And gold stocks, the producers themselves have been really struggling with the rising cost of production, which has outpaced the price of gold rising. But Paulson thinks that these stocks are undervalued, so we'll see.
And I know that you obtained his letter to shareholders, and it seems as if he is sticking by this bet on gold, right?
He is for sure sticking by it, even though he knows the numbers are really bad. So he said, "We believe in the long-term outlook for these positions as quantitative easing programs continue around the world, credit expands in the United States, and gold equities continue to trade at a significant discount." And other investors have agreed with this thesis. I've talked to other managers and investors who say you have to stay in this fund long term, play out the volatility, but eventually these stocks are going to rise. So we'll see what happens.
Now, he has billions of dollars in other funds. How are they doing?
A lot of his other funds are doing well this year, have done well in previous years. His Credit Opportunities Fund, which is his biggest fund, it's the fund that made his famous bet against subprime mortgages. His Recovery Fund, his merger funds, all positive this year. But his Advantage funds, which are event-driven, also down this year because of his gold bet. And his gold share class for all of his funds were down in the month of February.
The idea of comparing average hedge fund performance to the stock market makes a lot of experts cringe because they say it completely misses the point that hedge funds, there's hedge in there for a reason. But just out of curiosity, what do the statistics show so far?
Well, hedge funds so far for this year are still underperforming the S&P 500 and global stocks, which, like you say, it is problematic because these strategies run the gamut of credit to commodities to other types of asset classes. But they are still underperforming, and over the past 6 years, they've really underperformed every year except for 2008 and 2011. So it is problematic for a lot of investors.